So the topic for this section for this session this afternoon is wider fields. The first is a panel discussion on the power of public-private partnerships. And that is presented, there's been a slight change to some of the presenters compared to the program. We are joined by JOHAN, Jolly Mokorosi, Ndabe Mkize, and Theo Winter. Thanks, guys.
Is this working? Good afternoon, everyone. Just by way of introduction of the panelists, Jolly Mokorosi is a professional principal officer, independent retirement fund trustee, and regional business owner. And she serves on the board of a number of retirement funds in South Africa. She's also an advisory committee member of the SA Pension Fund Investment Forum, and her capacity today is that of the inaugural deputy chair of BATSETA's Asset Owners Forum of South Africa. And she's a director of BATSETA as well. She's also a member of the National Treasury's Taxonomy for Green Finance Working Group, as well as the JSE Sustainability Advisory Committee member. So Jolly will represent to us today in this discussion the views of and the perspective of asset owners, the ultimate asset owners, in this case, the large retirement funds. So we then have Ndabe Mkize. Ndabe is the managing partner and founder of MABABO Capital, which is part of the Capital Works Group. He was previously the chief investment officer of the EPPF, which is the second largest pension fund in South Africa. And having started in the actuarial field, he holds both a CFA as well as a CAIA designation. So Ndabe will represent the view of the infrastructure asset manager in South Africa. Finally, we have Theo Winter joining us, and Theo's professional career spans more than 25 years across investment banking, asset management, and capital markets advisory. During this time, he's worked in various specialist structuring and advisory roles in areas such as financial derivatives, structured finance, project finance, with a particular focus on renewable energy, private equity, private debt, and venture capital. So Theo's perspective today is that of the actual project owners and project developers and project financiers. So we thought we'd bring a different perspective of the various players in the industry along to talk about the power of public-private partnerships. By way of introduction, the Eskom data indicates that 4.4 gigawatts of rooftop solar had been installed by June 2023. So that is 4 times what it was in March 2022. It's a total investment of about 65 billion rand and almost 54 billion between March 2022 and June 2023. So to put that into perspective, 4.4 gigawatts, we've got 6.2 gigawatts of installed renewable generation capacity that was built in terms of the Renewable Energy Independent Power Producers Procurement Program. So, and that has been since 2011. So over the period of the last 12 years. We've also seen many large businesses like mines and even industries like Sasol making similarly big decisions to secure for themselves their own solutions by installing large, sort of between about 100 megawatts plus systems in areas with reliable and solar and wind resources. So these are generally built by independent power producers, and they get paid directly for what they generate by these corporates. And these deals are enabled by the so-called wheeling agreements. So you still use the Eskom grid, and that takes the energy from where it's produced to where it is consumed. This is known as the commercial and industrial space, and right now there is upwards of 9 gigawatts of these kinds of installations in the pipeline. So over in the next while, together with some of the further renewable energy bid windows, we will see 30 gigawatts of installed renewable energy capacity in South Africa. Compare that to the total energy system at this point in time of 48 gigawatts. Now, the knowledgeable people on this panel will tell me that 30 gigawatts of renewable energy doesn't mean that you get 30 gigawatts of power because of the energy availability factor. So it's not quite of that magnitude. Energy availability is 25 to 30% in general. So put that into perspective. One of the primary obstacles to that is the limited capacity of the grid to connect more generators, and that's independent of the technology. So that's the introduction in terms of the size and the scope of this market, and how fast it has developed over the last few years. So I'm going to ask Theo to give us an overview of the market from the perspective of power producers and other new emerging market participants like energy traders. Have you got a mic there?
Thanks, Johan. Yeah, so I've been involved in the space, in the renewable energy finance space for the last 10 years or so, more or less when the REAP program started, which most of you will be familiar with. So that was government's attempt or initial attempts to privatize and introduce independent power producers into the market. So I came at that industry having covered institutional investors for the first part of my career from the investment banking side. And the first thing that struck me when I looked at that industry is that it wasn't structured at all with the needs and wants of the institutional space in mind. So the REAP program was developed essentially by the banks for the banks. So for example, you'll find that the initial debt type of structures had to be essentially from cradle to grave, from funding the construction right through to repayment ultimately after typically 15 years of operations. That's not how it works internationally. Internationally, you typically just finance the initial project and then refinance into the institutional space afterwards. Another factor, there was a complete absence of CPI-linked debt. And as we all know, that's what the institutional market needs and wants. And more so, these projects, their returns are all CPI linked. So when you agree a tariff and you win one of those bids, it's based on an initial tariff, and that tariff gets adjusted every year by CPI. So it's a fantastic real income stream, which is exactly where the institutional balance sheets want to invest. But the banks don't really play in that space. I mean, you'll know there's an inflation-linked market, but it's very illiquid and it's fairly one-way bid because of the demand. So that struck me initially as kind of odd, and at that stage I was representing one of the local banks and told them to, for the next round, maybe try and include some CPI-linked debt in their funding proposals to the IPPs. After that, I spent some time working with and advising actually one of the developers, so the guys bidding into round 3 as it was at that stage. So they were developing a wind farm to propose into round 3, and convinced them to take the debt, try and raise the debt directly from the institutions, and not approach the banks at all. And that was quite revolutionary at the time. And we took that investment opportunity around and spoke to a whole number of trustees, asset consultants, conventional asset managers, and so on. And what struck us was that there was an immediate acceptance of the asset class and an interest in what the asset class can deliver, being, for example, inflation-linked returns, long-term cash flows, fairly consistent, we can talk about that, and importantly not correlated with the financial markets. As we know, for the efficient frontier, that is a fantastic asset to add then. The problem was, if you then put this, let's say wind farm XYZ in front of them, they have no idea whether it's a good investment or not. So at that stage, this was around 2013, there were no infrastructure asset managers around. And they all said, look, we'd love to allocate to this asset class, but who do we appoint? You know, we need an asset manager, or preferably 5 of them, to run the portfolio for us. So long story short, that exercise turned into my advising a new investment manager called Gaia. They're still around, and they're also in the infrastructure investment space. So I helped them set up that business. So today, there are quite a number of infrastructure-focused asset managers around, and Ndabe can tell us a bit more about that. But that's good to see. It just shows you how the industry has developed and where there was a big need at that stage. I think there's still a fantastic need and opportunity for more infra managers to be established. I also lived through the emergence of the hedge fund space, which is minute compared to the infra space. And we have, just think of how many hedge fund managers we have today. So there's still a lot of scope for infra managers to really put their products forward as well and grow the space. But today where we are is the industry is slowly developing. There's still a lot of communication gaps between those who need the money and those who have the money. And I think that is one of the areas that the actuarial society can also play a big role in, wherever they are, whether it's with the institutions or with the banks or with some of the consultants. And we can talk a little bit about what some of those roles are. But the market is absolutely huge. Just from the first 5 rounds of the REAP, there is currently around 150 billion rands worth of debt sitting with the banks. All of that debt eventually has to move to institutional balance sheets. Obviously, there's the related equity also that's held. A lot of that can be and should be with institutional investors. These are long-term assets. They're illiquid, but very consistent. So really, they don't even belong on a bank's balance sheet. Because of the illiquidity, the banks have to put up a lot of capital against them. So it's not very efficient for them. They make most of their fees anyway in the structuring of these transactions. So they're not really after the net interest margin. It also has tax complications and other problems. In short, my appeal today is just the institutional market should familiarize themselves with the asset class and really become involved, really seize the opportunity, see where the gaps are, and let's just make the market much more efficient. That's not even talking about the net effect on the lives of all us South Africans, where we are limited every day by load shedding and runaway electricity prices. So there's a real net social benefit as well. But apart from all of that, it's a fantastic investment opportunity. It's one that really fits into the institutional kind of LDI space. And I'm happy to talk a little bit more about that.
Thanks, Theo. We will come back to you with some questions. Ndabe, the question to you is, as an asset manager, you're exposed to the investment requirements for infrastructure assets, the hard and the soft requirements. And they can be challenging given the nature of the projects, particularly in the public-private partnership space. As well as the secondary implications of investments such as private energy generation. So what do you see as the key opportunities and challenges in this market from an asset manager's perspective?
Thanks, Johan. Maybe my interest in this area started a long time ago when I was still pursuing actuarial exams, learning about the PFI, the Private Finance Initiative in the UK, and seeing some actuaries who were kind of involved in those wider fields. Fast forward, 15 years, we've seen South Africa moving into the REIPP program, where the private sector can participate together with the public sector. It might have started with banks, but we started seeing those projects moving from the balance sheets of banks into asset managers. There was a time where I worked for an asset manager. It was actually the Stanlib in those days, and I think they were able to get some assets from the likes of Standard Bank. So you can see that banks would have looked at these assets and then moved them into the asset management space. I think a few years down that, we saw the governing party putting in election manifesto talking about actually having the P word, prescribed assets, and putting money into infrastructure and those type of assets across the country. And at that time, I was actually Chief Investment Officer of the Eskom Pension Fund, and I was the founding chairman of the Asset Owners Forum, designed really to get a number of pension funds to invest in the space. So we were able to look at that and see actually that if you look internationally, especially the large pension markets in the US, in Australia, in UK, they were already allocating about 25% of their assets into this unlisted real assets infrastructure space. In South Africa, we're sitting at a low single-digit number, less than 5%. I think still is less than 5%. So our idea was there's no need for prescribed asset. All we need to do is basically look at this as a viable asset that is needed in order to match the liabilities of a pension fund, because the cash stream is inflation linked, it's long dated, and it also has a very low cyclicality to it. I think sanity prevailed, and I think my colleague here, Jolie, is going to talk more about that. So not wanting to steal her thunder. I think when we started putting money into the space, creating a real assets mandate at Eskom Pension Fund, probably one of the first to do so, putting about, at that stage, it was about 8 billion rands, putting a lot of it in South Africa, the rest of Africa, and also internationally, and seeing all kinds of opportunities in this space and the returns that we can have. I think one of the constraints has been just the number of asset managers who can actually play in the space, and we have a viable track record both in the debt as well as in the equity space, and also just increasing the set of opportunities to not just look at energy but to look at other things. Although obviously energy is still a large chunk of what you see in the space. Probably more than 50 to 60% of the opportunities you will find in energy, especially renewable energy. But there are other sectors. There is things in social infrastructure, like healthcare. There are opportunities in digital infrastructure and various other things in the transportation space, toll roads, seaports, and all those things. I think if I just look at what has been a problem, though, is some of the constraints that when you're looking at the REIPP program, you can only bid when a bid window 5 or 6 has been opened, and sometimes these things get delayed. So even if there's money wanting to invest in that space, it is a public-private partnership. So the public sector does need to come to the party and be able to open up and make sure that they do the right things, that these things are structured well and have good governance. On the other hand, we have constraints with the transmission lines that can only take so much of the power. So sometimes you find that some of those IPPs are ready, but they just can't be connected to the grid. Especially in Cape Town, you're seeing areas where there just isn't capacity in the transmission lines to actually take more. There's also another capacity or another constraint, which is actually government and the municipalities. There's a story actually that came out in Business Day today about the Minister of Public Enterprise, Pravin Gordhan, talking about the fact that I think it was one of the, I think it's the Buffalo City municipality, has lost about 350 million rands in revenue because of people procuring their own power. Either individuals installing rooftop solar or the CNI private PPAs. And as much as we sympathize with that, but we are very much acutely aware that without power, the economy will not be able to produce the jobs that it needs. So a government will not be able to get the tax revenue that they require, and they will then be saddled with people who have now become unemployed and therefore need more social grants. So it needs to happen. But it does not need a rocket scientist to realize that if in a place like Cape Town, people are able to feed into the grid a lot easily than what we're seeing here in Gauteng, then it means that the private sector does need to talk to the public sector, to municipalities, to find ways of making them overcome their fear of losing the revenue. But I think those are some of the challenges that we're seeing. I think some of the challenges is actually the success of the REIPP program. It's been so successful that there's a wall of money has gone into the space. And you're seeing some of the OEM and the manufacturers in the Scandinavian countries bidding for these assets and basically driving the returns down to 11 or 12%. Now, if the bond yields are sitting at 12%, are you really going to put money into something illiquid at 11%? The truth of the matter is you're going to find it very difficult going forward to put new money into that space if the returns are very low. That is why some of us at MABABO Capital, we are looking at both the social infrastructure as well as digital infrastructure and overlaying some of those assets with rooftop solar. So looking at those things where you can actually put your own solar energy without needing a bid window 6 or 7 to be opened by doing your own rooftop solar, and where the initial yields are somewhere between 14 and 16%. Obviously, that will also grow with electricity tariffs. So those are becoming actually a lot more interesting from a return point of view, and also from the fact that you don't necessarily need the acquiescence of the public sector. But obviously, we're still facing the fact that the municipalities might not really allow you to feed that into the grid. You can only do the wheeling. And some of the wheeling agreements, I think, they're becoming even more innovative now, where it's actually virtual wheeling with multiple sources and also providing it to multiple PPAs as opposed to one party to another party. So I think there are some interesting things in the space. Certainly, asset managers are able to access projects that maybe government might not be able to do or do with speed. They're able to put the governance processes that will allow the pension fund money to actually go into that space without fearing that there will be malfeasance, there will be corruption, or just downright delays. So I think the asset management space has a tremendous role to play in helping the asset owners be able to realize their aspirations, which are to put money into the space, so that not only will they make good returns with an acceptable level of risk, but also have tremendous impact in the space by providing the services that are needed. But all of those things need asset managers who are able to fund the projects, invest them very well in order to make sure that the returns and the financial returns as well as impact returns are realized. I think I'll end there for now, but obviously I'll take more questions later on.
There will certainly be time for questions later. We'll leave 15 minutes or so for questions from the floor. But Jolie, the question that I think that Ndabe raised already is from an asset owner's perspective. Maybe you can go back and give us some more color in terms of the pressure that asset owners have been put under to invest in infrastructure, and possibly then talk about the opportunities as well as the obstacles to asset owners at this point in time, making further investments in infrastructure.
Thanks, Johan. Is it morning or afternoon? I've actually forgotten already. Afternoon, good afternoon, everyone. There are quite a few challenges that we face as asset owners. People look at me and they say, there's 4 trillion rand that's walking there. But it's not free money. That money belongs to workers for the most part. Workers like you and me. It's a very different thing being a trustee to being an investment manager. As a trustee, you are asked to look after this money which I am. I'm a trustee in most instances, better than you would look after your own money. And I saw Jonathan Mort around earlier, the pension lawyer, and he can confirm that for you if you really do want to know. So what does it mean? It means that we have to be mindful of a number of things. At the same time, from a social perspective, you've got to be mindful of the country that we live in, where more than 90% of our membership in retirement funds will not save sufficiently to retire comfortably. That's not going to happen for most of them. So when they reach retirement age, option B, C, D, E, F, G, all the way down to Z on the alphabet, and then A, A, B, B, C, C has to be looked at. So how we invest is key and it's critical. At the same time, workers are not stupid. They also look at us and say, you as trustees, where are you putting my money? You can't tell them you're putting them on some fancy instrument on the Luxembourg Stock Exchange called a SciCurve, or it's some synthetic something. The guy's like, no, this is very simple. You are to invest in businesses that make sense, right? From a worker perspective. You are to return a profit for me, right? Treasury has put it even in its own investment paper in 2017, saying that the most important thing to determine if a person will retire with sufficient means, the most important thing is actually investment return. So the return makes huge amounts of sense. Workers want return on that money. They need a return on that money. You as taxpayers need for them to get a return on that money, a good return. At the same time, the worker says, okay, why are you not investing where I am from? Because I've got an infrastructure deficit. The mine workers said straight to me, to my face, Jolly, we're from labor-sending areas. Why must I invest in things when I know that the place that I'm from has no electricity, it has no running water, we do not have housing, and it's not as if we don't want to pay for these things. We want to pay for these things. They are simply not there, okay? So make it make sense to me. Why do you want to take my money and invest in things that do not benefit me or my children in the long run, okay? So we also look at investments from the perspective of what does our membership want within a space that makes absolute sense to them and to us at the same time. There are prudent investment principles at play here. Many of you here studied in South Africa. You like our universities? That was pension fund money that built many of the universities that we went to, right? The hospitals that we go to, the roads that we drive on. Infrastructure makes sense from so many perspectives. Now, obviously, we don't want to return to the dark days of prescription, because it was prescription that brought about those same universities that some of us studied at. I myself went to a university that was built through pension money that was acquired through a form of prescription in the 1960s, right? Fortunately for us, as asset owners, government was prepared to listen. Myself and Dabe, as he said, put together a paper a couple of years ago. In addition, we flew down to Cape Town, had a meeting as pension funds with the ruling party, and we said, we've got a number of challenges. One, you need to look at the fact that you have actually never done an audit of what this industry looks like and what we actually have invested in what you call infrastructure. Have you also heard of this little obstacle called Regulation 28? We've got limits. We cannot actually invest more than a certain amount. Come to the party in this regard. Unfortunately, government did. In addition to that, there are groups of retirement funds that we've put together simply because the need for us as retirement funds was, if you're a small fund, which is anything above the top 100 in South Africa in my books, is a smaller fund, it becomes very difficult to invest in infrastructure in a way that makes sense to members and is not expensive for membership. In addition, you've got to model your assets with your liabilities. The gig economy is here for a lot of our funds. It means that, strangely enough, we're dealing with a situation where members are in the fund for a year, 2 years, and then they leave. Now, I don't know if any of you has ever gone to tell a group of members that they cannot have access to their money in the middle of a strike. Not something that is pleasant. You will not want to repeat that exercise if you make it out unscathed, right? At all. So we got to invest in a way that makes sense for the people who we are investing for. We've got to make investments in a way that makes sense for the context in which we operate. And that is why I like gatherings like this here, because it's a gathering of investment experts or experts in a profession that is South African. We cannot wholesale adopt what is happening in other jurisdictions, right? We've got to actually come up with our own things and our own way of doing things. I'm going to stop there for now and give time. Yeah. I could go on for a long time. I talk for a living, guys.
Thanks, Jolie. We're talking about the power of public-private partnerships. And one of the issues is the regulatory and policy environment and why that is crucial. So maybe I can ask each of the panelists to give us a view of what, from in your space, what are the big regulatory and policy issues, the critical issues that need addressing?
Yeah, so I think there are various levels of regulation that in the infra space you need to consider. I think the one that we as professionals here are probably most familiar with would be Reg 28. So for infrastructure, because of its private nature, that used to fall in the other bucket, so it's usually not listed. And simply not enough space in that 5% as it used to be to allocate substantially to these large projects. So luckily that was relaxed, and I think that's a success. That's a good first step from government side to allow and in fact encourage greater investment in unlisted infrastructure. Having said that, there are also structuring options available. It's not to say that you can only structure a project in an unlisted basis. It can be listed. I was involved with, for example, listing a preference share on the CTSE, and then it immediately falls into another bucket. So even though it's still illiquid, it is listed and it is regulated in that sense, and also then gives flow-through exposure to, in that case, it was one of the big wind farms in the country. So there are various structuring options available if one thinks a little bit creatively as well. But ultimately, it helps if the regulations are positive and encouraging for the type of investments available. And then obviously on the construction and operational side, the regulator is NERSA, and we've seen quite a bit of relaxation there as well. You'll be familiar with the lifting of the cap on production licenses from 1 megawatt to 100 megawatts. So that was a step in the right direction. There's also, in Parliament serving right now, there's an amendment bill to the Electricity Regulation Act that will allow for the formal splitting up of Eskom into the various roles. The transmission system operator, the grid company called NTC, National Transmission Company. So there are various steps being taken to liberalize the sector. And luckily, we're not doing this for the first time in the world. Many countries have gone through this. So there are very important lessons to be learned elsewhere, and we want to learn from them. So, you want to liberalize, you want to bring in trading, you want to bring in competition, you want to bring in fair access to the grid. One interesting question that we get a lot these days is how can people invest in the grid itself? As Ndabe mentioned, there's a big constraint in the grid itself. So even if you can get a lot of independent power production online, it still needs to be evacuated and distributed. So that can be done as well, but you know, it's essentially a regulated monopoly, the grid. Again, we're not the first in the world with that. Germany went through a similar exercise in their liberalization a couple of years ago. It was mainly around nuclear power, but they also split up the grid, put it into a separate company. And if you look back in terms of investment returns, an investment in the grid itself was actually the best investment, as opposed to investing in any number of you know, independent power producers and so on, because of the returns that were just bit down to very low levels. So I think investors have to be you know, careful in evaluating where in the sector they want to play. And the role of the regulators, as I see it, is to just establish a fair level of competition, and then to let the market find its way. That's when PPPs work best. When government does the opening up, enforces the rules, and then allow private and free market capital to flow where it's most optimal.
I think I'll focus a lot more on the regulation that's more financial, but before I go there, also just wanting to expand our horizons so that we don't think of infrastructure as just renewable energy. There's a lot more. On the transportation side, there are airports, there are seaports, and some of the you know, good performing stocks would be things that actually have airports in London as well as in China. So there's a whole smorgasbord of investments in the infrastructure space. But if I look at some of the problems that we're facing, we talk to, as asset managers, talk to a number of asset owners who say that the two-pot system and the implementation thereof is actually making them halt and not necessarily allocate money to the space. They want to see what's going to happen. We are seeing Regulation 28. Obviously, it's good now that you can put up to 45% in infrastructure. Not that you'd want to put 45% of your pension fund in that space. It's just to give you enough scope that should the public markets fall while your investment in infrastructure remains unchanged, you're not going to have a situation where you have to go rebalance quickly. Having been in that space recently, I know it can be very difficult when you have to rebalance those things. However, when that happened, we also relaxed our exchange controls. We can put 45% of assets in developed markets. And guess what's happening? People are putting money offshore before they look at things that are in the private markets, private equity, infrastructure, especially if you're going to have problems that people are going to be putting and saying, well, we need liquidity, we need those things. So I think there's a bit of an incentive that needs to be made in my mind, that as much as you will want people to diversify, but they also need to do that in a responsible manner. Something that I think certainly falls within the scope of actuaries are things like defined contribution pension funds. You tend to find people justifying why they're not investing in infrastructure and in real assets. I prefer to use the word real assets to cover both infrastructure and what probably looks like real estate, but it's still part of infrastructure in my view. Is that they are in a defined contribution plan. It's easy for a DB pension fund to invest in the space. Yet if you look at Australia, which is largely a DC market, they have been investing in the space. So I think it behooves actuaries to find ways of being able to invest in investment that makes sense. I'm not saying that there won't be any challenges, but find ways of overcoming those challenges. For example, people tend to think of infrastructure as this thing that is illiquid. But if you're investing for a long term, you're not necessarily buying this asset to sell tomorrow. All you want is to be able to get an income return that is high and is growing with inflation. And actually, you'll find that the dividend yield in the stock market is about 3.5%, a lot lower than the initial yield that you might get from your real assets, which could be 8, 9%, and then growing with inflation. So I think thinking about liquidity issues needs to be looked at a lot more creatively than other people are looking at. Umbrella funds tend to also be an issue. And you can see there's a lot of money moving into umbrella funds. I'm not making an argument whether that should continue or not. All I'm saying is that umbrella funds tend to invest in multi-asset balanced funds or multi-managed funds. So those multi-asset balanced funds tend not to invest in private markets. If they did invest, then the umbrella funds would immediately have an exposure. And given my interaction with some of the people who run umbrella funds, they basically said, we have to invest in these through these asset managers. So if those asset managers do not allocate anything to infrastructure, well, we don't have any way of forcing them. So talking to those big asset managers who run these balanced funds and saying, why is it that you can actually have a fund-of-fund structure, maybe where you put UK specialist value manager as part of your offering, but you can't actually put a real asset or a private equity offering that will still give you a good total return. The response I got was TER, total expense ratio. So in a way, we've been penny wise but pound foolish, not understanding that actually what an investor eats are net returns. Net of fees, but net returns. So if you're going to have something giving you a 15% IRR for 10 years versus something giving you 12%, just because the one that gives you 12% is only costing you 30 basis points, and the one giving you 19% is costing you 1% or 100 basis points, you're still better off with the one that has a higher return, especially if that return is predictable. But because of TER and everybody focusing in this space, measuring TER, and no one guiding them how to choose those investments very well, you're finding asset managers not putting their money. And actually some of them saying even what they were doing internationally, where they might allocate to some of the specialist but top performing outfits internationally, they might even have to pull that money out of those structures because of TER. I think actuaries have a pivotal role to play in educating the market and also finding ways of making sure that the excuse of the umbrella funds for not investing in this space cannot be that there's TER or that the underlying asset managers are not investing in this space. I think that's a large untapped opportunity, and we cannot leave it to large pension funds like EPPF and GEPF and Sentinel and those ones to do the job, while umbrella funds are not doing the job. When it's all said and done, if one really believes in this infrastructure, one believes in the gross capital formation, all hands must be on deck.
Any comments from you, Jolie?
I've got lots of comments.
I don't want to cut you short, but I also want to take questions from the floor.
Yes, I do want to start off
choose your best ones.
With the question that you did ask. And I think that where government can come to the party is guarantees. Guarantees, guarantees, guarantees right at the beginning. A lot of retirement funds cannot take that level of risk right at the beginning of projects. So in the greenfields projects right at the start, whether it's the cost of the due diligence, whether it's the assessment of the actual opportunity, that government actually takes on the burden of that cost. They've got a much bigger cost base and can absorb it better than a lot of the funds can. And once that actually happens, it makes it a lot more easy for some of the other funds to come on board, and it isn't necessarily the bigger government funds that do come on alongside with government. And then also assessing just simple things like the definition of infrastructure. We had meetings with Infrastructure South Africa as the Asset Owners Forum, and their definition of infrastructure and our definition didn't align, which then makes it very difficult to compare apples with apples. And creating the policy environment for other retirement funds to come alongside us. This time last week, we were hosting some of the biggest pension funds in the world. People like CalPERS, the New York Systems a group of retirement funds, a couple of the other funds from California, massive funds. I mean, one of those funds has more money than the South African GDP. However, because we're not structured in a way that they can come alongside us easily, it then makes it very difficult. It's two extremes. For the one group, our ticket sizes are too small, and for the other group, for us personally, our ticket sizes are too big for a lot of us to get involved in that space. So government can certainly help out with lowering some of those barriers.
Great. Thank you very much. I know there's more, but thank you for that. I'd like to take some questions from the floor, if there are any questions from the floor. We've got 10 minutes or so, is that right?
Yeah.
There's a question over there, so there's a mic.
Yeah. So I think it's an interesting topic. I think my key question would be to Ndave. I think when you look at this infrastructure investment, when I've advised boards of trustees, I think there is always a key man risk in that when the pension fund is actually not big enough, we don't have the skills in-house to be able to do the assessment. So now when it comes to the due diligence, we are relying on the asset manager. So we are relying on you to present the skills that we need for the due diligence. So we are leaving that up to you. And then when it comes to the ongoing valuation also, because this thing is not listed, we also rely on you now in terms of coming up, giving us the subjective valuation to say how much is this thing worth, what is the return that we've earned on that. So once that starts happening now, when you try and do the look through to actually see to the actual investment also, we don't have the skills to do that. We're not like an ESCOM or a GPF. So that now, when it comes to that, when you then look at the members, now when you're trying to explain this thing, if you can't explain that thing, then it also means that to the members, you're not being transparent. So I don't know how you guys are addressing that. But for me, my discomfort comes from the fact that you are too reliant on the asset manager. It's almost like the player and the referee when it comes to this thing. And you've got no other recourse unless you've got to go and now engage another set of experts to come and give you a peer review of what you are being told. Yeah.
I'll answer it. I think also my colleague would also come from the asset owner's perspective. But let me start from the asset manager. I think the private markets do have what is known as information asymmetry, which means the person selling something to you knows more about it than you. I think that was a reason and an excuse 5 years ago. I think there's a lot of education that has taken place through the Asset Owners Forum, through asset consultants themselves upping their game and really being able to see and understand the space very well. So I think to a certain extent that information asymmetry has been reduced. For example, the due diligence, there are a number of asset consultants, the large ones, who have invested a lot in this space in understanding. So while an asset manager would come and present an opportunity set, be it in infrastructure or in private equity, you are also going to have a major asset consultant being able to evaluate that and see exactly what's being done and evaluate it not only across projects and investment opportunities available in South Africa, but internationally, and also to see how that will align with the required actual rate of return. I think when it comes to looking at the valuation of those unlisted, again, there are asset consultants who are offering those services. So I think it's a question of an asset owner looking at their current service providers, and if that current service provider is limited in the in the private market space, perhaps we should consider having a specialist service provider who could fulfill that slot, and it would not be pushing the envelope. We know some asset owners, if they have an asset consultant perhaps who's only familiar with the mainstream assets, and they want to do, say, a manager development program, they can bring aside someone who can who can fulfill that role. So I think not having a one-size-fits-all is important, but being able to choose your investment advisors and asset consultant according to the value that they can bring. Because if you think about it, when a large number of international pension funds have put 25%, actually 26%, according to the Thinking Ahead Institute, and that was as far back as 2020 in this space, we cannot be languishing at 5%. Whatever it is, if it's information asymmetry, let's actually do that. And the Asset Owners Forum was created, one of its reasons was actually to reduce that information gap. So I would say that a lot has been done, and asset managers certainly cannot mark their homework, but I think, Jolie, maybe you might just want to add one or two things in that regard.
Yes, so I do practically come from an example of such a constraint. I was investment committee chair of the Transport Sector Fund when we bought truck stops to put up. It was a 3 billion rand fund at the time, pittance for infrastructure investment. We did have to fly somebody from the UK to help us with valuation of those assets because we struggled to find expertise locally. I personally had to do phone calls to some of the professionals who were involved because we didn't know who else to ask and how to ask. We lived in fear that we'll end up on the front page of the business day because we've made a mistake with the assets as a bunch of trustees. And eventually, when we hit our Reg 28 limit, I had to go knocking on Dabe's door as EPPF and say, hi, we want to put up 8 truck stops in South Africa, but Regulation 28 is going to limit us to 2 truck stops in the country. We have truck drivers who do Cape to Cairo, and we would actually like to put them up across the continent. So very difficult journey, but not impossible. I think that was what that experience taught me, that where there's a will, there is a way. We still did get it done. And during my tenure, I'm proud to report that in the first 6 months, we had 9% ungeared return of those truck stops being in operation, which is the kind of investment that anybody would not scoff at. Now, we've made a lot of headway around those information gaps, cooperation, and we do have people like Mercer who've come alongside the Asset Owners Forum and a couple of other players like the banks and other larger retirement funds that are better resourced so that we can spread the load in terms of some of these deep and dark options that are out there.
I want to, thanks for that. It's an interesting question. I want to conclude because I think we need to conclude. But the issue for me is the opportunities for actuaries and the actuarial profession, and how you see that and why it is relevant, to this gathering. I mean, I can certainly see a lot. I mean, we've seen in the UK with the Institute of Actuaries that actually were part of establishing the pensions infrastructure platform that started investing in a lot of infrastructure assets, and finally it was actually, I think, recently spun off as an independent asset manager. I think we also saw cooperation between the Institute of Actuaries and I think it's the Royal Society of Civil Engineers that created a risk management protocol called RAMP, which is widely used in infrastructure assets. So there are a lot of opportunities for actuaries. Locally, I think the very interesting one is the valuation of some of these renewable energy and particularly energy projects. It's a nice actuarial challenge in terms of modeling, stochastics and interest rates and CPI. It falls squarely within the ambit of a valuation type actuary. But I mean, do you have anything that you see in particular around the opportunities for the actuarial profession or for actuaries in general?
Maybe let me start there. Well, actuaries have participated in the creation of indices, the JSE Actuaries Index. So I see some of the challenges that we're facing, especially in terms of valuations, being something that actuaries can actually tackle. Some of the projects or some of the infrastructure assets, lend themselves well to being what is known as ILB replacement. So if you can have something that actually gives you an initial yield with inflation-linked escalations, it falls within that real asset, that real framework. So just like one would be able to evaluate bonds and the illiquid ILBs, we believe that those techniques can actually be applied there. That should not be a reason to dissuade. And also, if you look at investments in private equity, which is not necessarily infrastructure, but it's private equity, there are international guidelines that are actually given to how you actually evaluate that. So I think there's a huge role that actuaries can do to educate themselves and to also educate some of the stakeholders regarding the evaluations of these assets.
Yeah, look, I think the infrastructure space was made for actuaries. You know, it's very quantitative. It's cash flow based. The banks currently approach it from a purely kind of banking point of view, which is too short-termist for the institutional space. So I think the space can really benefit from the combination of quantitative skills and also applying it, you know, to long-term investment horizons, the kind of LDI type investment that actuaries are very familiar with. And really there's still a big communication gap in that space. So a lot of the model audits, for example, are still done by the audit firms. You know, and again, they don't really come with an institutional investment kind of focus. Really the sky's the limit. Asset allocation, quantitative skills, you know, data analysis, you know, machine learning and AI. Of course, these are required in many different industries. But in energy, it's, you know, highly data intensive. When you get into areas like forecasting, you know, weather-based models, you know, wind distributions, solar irradiation, you know, I mean, really you could just statistically spend all your resources on that. So there are various places for actuaries to get involved. And I really encourage the society to explore those and to bring them to the attention of future students as well, and the various career paths that are out there in this space.
Final word from you, Jolie.
I think that there's a deficit of actuaries that are involved, a massive deficit of actuaries involved, whether it's in the government space. Even when I still worked full-time for one of the big insurers, in my engagement with government, there were no actuaries on the government side other than those ones who worked for GEPF or one of the other retirement funds. But when you're making big national policy issues, especially around things like this, you definitely need people who understand the institutional space and are Africans, not to crowd out any foreigners or anything like that, but we frequently get foreign input in those key areas from people who do not understand the context in which we operate. So there's definitely a massive deficit of actuarial minds who work inside government. Also, those actuaries that are prepared to bridge the gap between the retirement funds or the asset owners and these projects or initiatives on the ground, there's still massive gap. We actually need you guys there to break down what's happening, to make sense in our space. And that's where the fear lies for a lot of us, crossing that divide. It's like, where's my actuary? Nowhere to be seen, because that's not a space that they want to play in. So I do think that if you are interested in that side of things, please do get involved. There is definitely a need for you there.
Thanks very much. It's up to me to close off the session and thank the panelists for a very interesting discussion, I certainly thought. And thank everybody for attending. I can't believe that you skipped some of the other more controversial sessions to join us, but I'm very grateful for that. Thank you.
Thank you. Thank you very much, Johan. Thank you, Jolie. Thank you, David. Thank you, Theo. We appreciate it. And I know our time for questions was cut short, but there is a function in the event app where you can connect with the panelists. If you go to the agenda, look for this discussion, look for their names. You can send them questions directly. If they have time, then they'll engage with it. Thank you so much, guys. We really appreciate it. We're going to allow some time for those who are walking in to find a seat and get settled, and then we will continue with our focus on wider fields, and our next presenter will come up in a few minutes.